Good afternoon. I am Cecil Lawrence. This video is a very basic introduction into options trading. Here we've got a market that's made a fairly sustained upwards move. It then made a correction here, and it now looks like the uptrend is going to continue. So it's made that new high and a small correction here. So a natural entry point for this market would be to trade the market up, to buy the market if it takes out the high of this green bar that you see here on the right hand side. So and the natural stop loss would be just below those two orange bars. That's a fairly good trade. So that distance there, that's about $200. So on this trade, on that green bar, you would enter the trade. So that takes out the high of this green. So as it trades through that high, you into the trade, you buy this market, and you're fairly happy on the close of that day. But then the market does this. Look at that downwards move. So it traces all the way back down, and it takes out your stop loss. That is down here. That's a $200 stop loss. You cannot take the chance at this point in time. You do not know how far down this market will move. So in keeping your losses small, you're out of the stop loss, you're out of the market. So you're taking a loss of around $200, and yeah, you're not part of this trade anymore. And then the market does this. Look at that beautiful uptrend that starts in form. It's a great trade. So there's a huge amount of profit that could have been made here, but you're not part of the trade anymore. You entered, you were kicked out on your stop loss, and you're out of the market, and you miss the entire trend that you're seeing there. Let's take an example of a downwards trending market. So here you've got a market that's trending down, makes a correction, it trends down, makes great typical sawtooth action of a trending market. So for us to get part of this market, to partake in this downtrend, we'd like to short the market if it goes below the low of this orange bar, the last low. It's made a little correction there. The natural stop is just above that green bar there. That's about $200. So that's our entry, that's our exit. Let's look at what the market does. So hey, so we kicked into market here. So if our entry was just below that orange, probably on this orange bar as it trended down here, we short the market. And then the orange went back up. It's a bit troublesome. But now the market does this. Okay, so at that point that's our stop loss above that green bar. So as the market made these moves, we can't stay into this market. We can't take the chance. So we're getting out of this market. We entered just after entry. The market went back up. We take a loss of around $250. We're out of this trade. And then the market does this. And there's a downtrend that we've been waiting for. So it goes all the way down. There's nice profit to be made here. But the market kicked us out of the market. So we went in the low of that bar, we went out on stop loss as it made this correction, and now only does the downtrend occur. We're not part of this market anymore. So how does this situation improve with options? Okay, so an option fixes the price at which we'd like to enter a market, whether it's trading up or trading down. An option fixes the price at which we would like to trade the market. It fixes that price for a certain period of time. We pay a small premium to acquire that option, and we can always sell the option back and then get some of the premium that we paid for it back. Okay, so let's move back to our first example, which was this trade here. Remember now, an option fixes the price. We're not part of the market. We can enter. We may enter the market at a certain point in time at the price that we fixed, but we're not part of the trade. So let's go back to that situation here. And let's say we purchase an option at the price of around $2,800. So an option at that price will fix the price for us at 2800. So we have the ability to buy the market at 2800, and it's fixed. We've got the option fixes the price, and the option says for a certain period of time we are allowed to buy this market at 2800 should we want to, but we're not into the market. So at this point in time, we're just sitting on a sideline and we're waiting to see what happens. Just one thing, you don't have to buy the option at 2800. It could be an option at 2850. It could be actually at 2825. So the price that you try to fix, that's variable. You can decide at which price you'd like to fix. Different prices, obviously, the options will trade at different values. So, but for this example, let's say that we fix the price at 2800. So we're not into the market. We just have an option to buy at 2800. So when the market did this little dip here, we're just sitting on the sideline. We're just waiting to see what the market wants to do. So at that point in time, when we reached a low down there, that's a loss of around $100 in a premium. If you decide to buy back or sell back the option to someone else, you'll make a loss of around 100, maybe 125 US dollars on that option. So it's a really small loss within our ability. So but we still have this option. Now we wait and see what the market does. And so, as the market makes this huge upwards move, it suddenly makes sense to buy the market down at 2800. So you just phone your broker and you say, well, broker, I've got this option. I'd like to buy this market at the price of 2800. And that's what the option does. The option gives you ability to still buy down at the price that you fixed. So now, with the price trading up here, you'll buy the option, you use the option, you buy the market at 2800, and then you realize a profit of 2800, 2950. That's $1,500 US dollar profit on this market. So then you realize a profit in this market. So and that's the beauty of what the option does. It fixes the price at which you'd like to enter without you entering the market. You now wait and see what happens in the market, and the moment that the market has made its move, then you decide, listen, I'm going to buy the market down at the price that I've fixed. And that's what the option does. So let's look at the downtrending market, the same example that we saw here. Exactly the same thing applies here. We could say, listen, let's fix the price at which we'd like to sell this market. Let's fix it out there. That's about 890. So let's fix the price at 890. So we've got the ability to sell this market at 890. We have not yet sold the market. We only have the ability to sell the market, and we fix that price and through an option. So we bought the option, and the option gives us the ability to sell the market at 890. Now we wait and see what the market does. So as the market trades up, that correction that we saw before, as the market made this correction, it's, there's a loss in a premium. At that point, maybe $100 loss in a premium, but you're still sitting on the sidelines. You're just doing nothing. You've got the option. You can decide if you want to enter the market and if you want to when to enter the market. So we're just waiting. And now, as the market starts making its actual move, it's making this downtrend. Now I say, well, it makes sense to sell this market. So now you just phone your broker and say, well, I've got the option to sell the market at 890. I'd like to make use of that option. Please sell the market at 890. So please note, you're not selling the market at 830 where it's trading. You're selling the market at 890. You can immediately buy the market at 830 and realize a profit between these two prices. So in summary then, what does the option do? The option allows you to fix a price at which you like to partake in the market, whether that's buying the market or whether that's selling the market. The option fixes the price at which you will want to trade. It fixes that price for a certain period of time. You can decide, how many days. It's 2 weeks or a month or 2 months. For how long would you like to fix that price to give you the opportunity to enter the market? And you pay a certain premium on that option, and obviously that option is tradable. So if the market is moving the wrong direction, you can always sell the option to someone else and get back some of the premium that you paid for the option. So the option fixes the price, and now you wait and see what the market does. And the moment that the market has moved favorably or in your direction, then you say, well, it makes sense now to make use of the option. It makes sense to enter the market, in this case that you see here, to sell the market at that point in time, at that price. It makes sense to do that. I'd like to make use of the option and sell the market, and then I make my profit. And exactly the same with the other example. Let me get it back on screen here. So it made sense to say, well, I'd like to buy the market down at 2800 when the price was trading at 2950. It makes sense to buy the market. I'd like to make use of the option, and that's it. That's what the option does. So it's an instrument by which you fix a price at which you'd like to enter the market for a certain period of time. You fix that price, and it gives you the ability to enter the market down at that fixed price whenever you'd like to enter the market, if you would like to enter the market. Thank you. That's the basic introduction. Yeah, enjoy. Bye bye.